So let's read the question. It says, I hope everyone is here. Swara Limited has been suffering great financial the financial stress. Well, distress, senor. Yes, it was financial stress. The directors of Swara Limited decided that the company should be reconstructed. The following was the statement of financial position of Swara Limited as at 31st March 2021. So, balance sheet, as you can see there is nothing serious about it. So, additional information. Number one, on 1st of April 2021, a new company known as Twiga Limited was formed to take over the business of Swara Limited. Twiga Limited was formed with an authorized share capital comprising 600 million ordinary shares of shillings 10 each and 40 million 6% preference shares of shillings 100 each. No problem. Preference dividends in Swara were 2 years in arrears. No problem. 3 ordinary shares of shillings 10 each, credited at shillings 5 each in Twiga, will be issued for each preference share in Swara Limited. In addition, 1 fully paid preference share in Twiga will be issued for every 4 preference shares in Swara Limited. The preference shareholders will, however, pay the balance to make their ordinary shares fully paid. So you see they were 10, but they were given at what price? 5. So when we joined the other company, we paid the balance of how much? 5. Correct? Number 4. The preference shareholders in Swara will forego a half of the preference dividends in arrears. That is okay. And will receive fully paid preference shares in Twiga for the balance of the arrears of the preference dividends. No problem. 1 ordinary share of shillings 10 each, credited at shillings 5 in Twiga, will be issued for every 2 ordinary shares in Swara. The ordinary shareholders will, however, pay the balance to make their shares fully paid. No problem. They are just compensating the ordinary shareholders. Number 6, the debenture holders will receive half of their dues, excluding accrued interest, in 6% debentures of Twiga, and the balance in fully paid ordinary shares of Twiga Limited. Interest accrued on debentures will be paid in cash by Twiga Limited after taking over Swara Limited. Trade payables, that is number 7, trade payables will be taken over by the new company and immediately settled by issue of fully paid ordinary shares of equal value. Okay. The assets were transferred to the new company at the following values. So land, plant, furniture, investment, inventory, receivables, cash. Those ones were transferred. Twiga paid 30 million to Swara to pay for the solution expenses. Hii price imekuwa 30 throughout. Twiga Limited issued for cash and at par all the remaining ordinary shares and preference shares not issued as part of the settlement of the purchase consideration or acquisition of Swara. Assume that all the above transactions were completed on first file. Required. 1, the following accounts in the books of Swara: realization account, Twiga Limited account, ordinary shareholders and members, preference shareholders and members, statement of financial position after completion of the file. Ikikuja huko kwa mtihani, tutaanza. Let's start. Realization account. Let's start with the realization account. Start with the realization account. So say there, realization account. Realization account. Shillings are in. Alright, so those assets which have been taken over, close them in the realization, but at their net book values. Close them to realization account, but at their book values. So you know the ones which were taken over if you scan note 8. So all of them you close to realization account at their net book values. So let's close them. Now that buildings. Under buildings, 21 for 200. Plant and machinery. Plant and machinery. 15. 91. 200. Furniture and whatever. 594. 600. Investment. 345. Goodwill, patent, preliminary were not taken over. Sure. In the note 8, the items which were being acquired, were they taken over? No, they are not taken over. So those intangible assets which are not taken over by the new company will be written off to the ordinary shareholders' accounts while you have suffered those losses. So those three, we write them off. Continue. Inventories. Inventories were taken over. 975. Receivables. 858. Cash at bank. 271. 200. Then you know the obvious. There are two which we said will be captured. Gilbert, which one? Which one? There are some two to be captured here. Reference dividends in what? Arrears. No part of that. Reference div in arrears. Organize them, then they will be compensated later. So that was in which note? Additional information number? Number 2. Check number 2. Preference dividend in Swara were 2 years in arrears. So just go to the balance sheet, you check the rate of dividends, you multiply, then you multiply by 2 years. So they were paying at what rate? 8%. Yeah, 8% times. What was the value of the 3.6 million? But they were how many years in arrears? 2 years. So you multiply by 2 years. You multiply by 2 years. How much? 576. There is one more I want us to capture. This side. which is the cash book, the amount they are paying for us to cater for liquidation. So cash book, liquidation cost. Liquidation cost. I remember it was said somewhere 30. Yes, it was mentioned in a certain note as 30. That was note number 9. So apart from the assets, always bring those ones. Then let's bring the liabilities taken over. So liabilities, where are they? Most of the current liabilities are normally compensated. So current liabilities, we have payables. We have payables. Payables is how much? 876. Interest, accrued debenture interest. So accrued debenture interest. How much is this? 144. That is it. So you leave it hanging until we complete these other ones. So the other ones, which one comes next? The purchaser's account, and which actually today it is required. Yeah, it's required Roman 2, trigger limited account, but there is nothing we are going to post. So this is Roman 1. Can I fix it here? Yes. Trigger limited account. So draw trigger limited account. Yes, please. Note about? Not 7. Let me check. So trigger limited account. For trigger, you will debit with purchase consideration. Purchase consideration. Purchase consideration will go to the realization. That is what we have realized. Realization account. So that account, you leave it until you are done with all other entries. Note number 7, where are you? Trade payables. Yes. So Nasema trade payables will be compensated. We were given ordinary shares by trigger. See, another one they're telling you trade payables were acquired. It was acquired. Here we are closing the assets and liabilities. That what? Acquired. See, nani wamewapea shares? Who has given them shares? Ni trigger. Tumeshafika kwa trigger. Sio kwa swara. Na kwa nini unaenda kwa trigger? Tukifika kwa trigger, kwa journals, we will give them shares to compensate. Meaning, it will not appear in the balance sheet of trigger because they were compensated. Melo, okay. By them saying that it was compensated, it means they were taken over. And here we are closing all the assets and liabilities taken over. When you want to settle, you need shauri yao hata tukiwa kwa swara hata we don't want. We are taking over, yes. Enda mpange huko mbele. So leave these two hanging. Then we go to Roman 3. Roman 3 is ordinary shareholders and members account. So have that one. Roman 3. Ordinary salary. Members account. Shillings are in thousands. So what you do, can you just start? Then while you utakwama ndio sasa utaona tukifanya. Can you just post? Masomo imekuwa kitu kingine. Kuna mtu ameulizwa hii ni masomo aina gani? Ukitoka kukuja shule umeulizwa hii ni masomo aina gani mpaka you can refer to how we were doing it yesterday, that account. Pole you check how it goes. Melissa. Okay, so let's check. Balance brought down. Sure. Yes, so we start with the balance brought down. How much was the balance of this ordinary shareholders? 3 million. 3 million. Was there any reserve? No. We don't have any reserve. So to indicate, yes. So revaluation. If there was revaluation, kindly show them. If there is share premium, give them there. Retained earnings was there, but negative. Profit and loss, and we call it what? Accumulated losses, 25-20. And all intangible assets which were not taken over. Bring here. Goodwill. Goodwill is one of them. How much? 90. Patents. Patents to 40. Preliminary. Preliminary is how much? 100, 800. Good. Then they will get something from trigger. So from trigger, we check which note? Note number 5. So note 5. One ordinary share of shillings 10 credited at 5 in trigger will be issued for every 2 ordinary shares in Swara. The ordinary shareholders would, however, pay the balance. Balance is later to share the over. So from trigger gave us ordinary share capital. On what basis? 1 for every 2. How many were we having? 300,000. Is it the power is 10? Yes. So 300, and they were credited at what price? 5. So what will you get? 750. Question. Close it to realization. Close it to realization. It is done. So let the camera in. Bring something. So it is balancing on which side? On the credit. With how much? 1 million. Oh. Flat. 1 million like this. Is balancing with how much?
1 million.
1 million. 1.8.
Yes.
1 million.
So what is the
1 million.
Sasa
1 na 0.3.
0.3.
Yes.
Comma.
Like
Like that.
Yes.
So close that one to realization account. On which side? On the credit. So on the debit, so you debit realization with ordinary. So ordinary sundry 1,000,800. Next. Next, they want what? They want us to prepare preference shareholder sundry members. Also startup. This is question for us to check. So preference sundry members accounts. So preference sundry members preference sundry members so preference sundry members thousands. Can you start? Kila mtu ashaona kwenye amefika. Jana ulikuwa? Jana ulikuwa? Oh, umefika basi kidogo. Haya, sawa. Haya, balance brought down. Balance brought down. So connect. Balance brought down. How much was their capital? 3.6. 3.6. Something else they will be entitled to? The arrears. Yes. So preference is in arrears. We have even calculated it. How much was it? 560. 576. 576. Then, of course, they will get compensation. So reduce their claim from where? From trigger. I check which note and which note. 3 order and 4. So 3 ordinary shares of shillings 10 credited at 5 in trigger will be issued for each preference share in Swara. Before 22, in addition, let's capture that. So ordinary share capital on what basis? 3 ordinary share for 1 is 3 for 1. How many preference are we having? 22. What was the power value? 50. So 3.6 divided by 50. You are saying 72. So 72,000. But these shares are credited at 5, giving us 1080. 1080. Then a complaint. In addition, there is that in addition. In addition, 1 fully paid preference share in Swara will be issued for every 4 preference shares in Swara. Yes. So preference in trigger. So trigger is the one issuing. They were, what was the percentage? Check where the question started. You have to see consist. The ones in Swara were 8%. But the ones we are getting from trigger, where the question started not 1, they are 6%. So 6% preference share capital. They are getting on what basis? 1 fully paid will be for every 4. So 1 for 4. But we are having 72. And those preference they have said fully paid. Eh? Yes. So fully paid. Check those 6% up there. What was the par value? It's in 100. Yes, so you multiply by 100. You check note 1. The preference shares in trigger were having a par value of 100. So when they are giving them, they give them at 100. Charles, why are you using this book? Why are you using this one? Ile ya kwanza imejaa. Kuna watu pia wamejaza kitabu. Ile watu wamefika katikati. Oh, walikuwa tumia 96 pages. How much is this? 10? 1.8. Using my 8 in the meter. Like that. So that one was to compensate the capital. Let's go to arrears. Arrears they are compensating in note number 4. So read note 4. The preference shareholders in Swara will forego a half. Yes. They will forego a half of the preference dividends in arrears and will receive fully paid preference shares in trigger for the balance. So they will forego a half of this. Then the balance they will receive in what? Preference. Sure. Yes. So a half of 576, giving you 8. Cushion. That is it. So close to realization. Can you balance that account? Balance that account. So balancing is on which side? On the debit. With how much? Realization. How much? Again. 10. How many zeros? 1. Then how many zeros?
2 zeros. Then 3 zeros.
Like this.
Yes.
This one was meant to confuse people, right? You know, when you do that, you are getting similar, almost similar figures all the time. All right, so as simple as that. So you come this side, it has balance of the debit, credit, realization with 8% preference sundry. 1008000. No. There's an account I want you to do for me, but it's quite short because I don't want to leave these items. So, which one do you think I want us to prepare? You are very serious, huh? Yes, the 4% debentures. Above that account, I want you to do it as we just discussed as you do. So, right there, 4% debentures. 4% debentures. 4% debentures. 4% debentures. So be ready. 4% debentures. Cost balance brought down is on the credit. There's something I've noticed in this class. Ukiona boy child wanatumia ruler, ujue watu wako very serious. Seriousness has been taken to another. Hapa mbele naona ruler. Wenye wana ruler mpaka wako na pencil. Yes, it's good to make your work presentable. So balance brought down on the credit, debentures 2.4. So can you capture that 2.4, please? Then let's check the note where they are being compensated. Which note? Note number 6. So check note 6. Your story go up. Oh, 6 because you are not 7. So the same explain. So note 6. The debenture holders will receive a half of their dues, excluding accrued interest. Excluding. So accrued interest was on the other, it was taken off. Excluding accrued interest in 6% debentures of trigger. And the balance, the balance better than half. And the balance in fully paid ordinary shares in trigger. So do this. On the debit, say from trigger, I have 6%, you write 6% debentures. So from trigger, the first one is a half. The first one is a half, which is 1.2. So 1.2 is 6% debentures. Then the balance of 1.2 in ordinary share capital. So make an ordinary share capital 1.2. Funga your account. Tuko sawa?
Yes.
If I can show it here, it is 6%. It was 4% debentures. Brought down, you have said 2.4. Then from trigger, 6% debentures 1.2. Then ordinary share capital 1.2. Fisher. So that one has no balance. So now I want us to go back to trigger limited account, the required Roman 2, so that we close it to help us get the purchase consideration. We close to realization, then we are done. So let's go back to trigger. So trigger, I want you to credit trigger with all the items we have received from trigger. So I want you to credit the account with all the items they have given. So far, they have been giving out what? Ordinary share capital. So can you check from ordinary sundry? We got ordinary worth how much? 700 and what? 50. So I want us to add them. We got 750 plus preference. We got 1080. We got 1080. Then to compensate the venture holders, they gave 1.2. Can you add? 30-30. So this is 30-30. 30-30. Something else we received. 6% what? 6% preference share capital. We received them in the preference sundry. So this is 1.8 plus 288. Can you add those two? 2088. Then something else we received. Check debentures account. Check your debentures account. We received 6% debentures. 6% debentures, 1.2. And finally, we received what? Cash. The cash they gave us to cater for us. Was that?
Yes.
Yes, Fisher. So the total of what we received is the purchase consideration. So can you add? Akimungu, si ukwetu na sisi walete kitu kama hii. Si ukiona swali kama hiyo kwanza utakohoa. Ama una whistle? Haya. Unaweza lenga hiyo kukutana naye hiyo siku. Unararua. Kurevise after exam. Oh, sawa. So total comes to 63. 48. Haya, rusha huko kwa realization. For Trigger Limited, that is the consideration. That is an income to us. 63. 48. So to confirm whether we are accurate, realization must always balance. In examples here, unaweza kuwa umepata hata labda iko sawa na venye umeadd tu kitu mbaya hapo ndani. So just leave it. They will mark the entries. So can you confirm whether it is balancing? Here we can counter check if there is an issue. Exam hakuna time kama hiyo. You can confirm now between internal and external, which one is somehow better? External is somehow better. So internal is one story there. But make sure hiyo wanajuanga ile iko na story hata wanaweza leta tena. So usiende kwa internal uandike realization account. Instead of realization account in internal, you write which one? Daily account, capital reduction. It is balancing. With how much? 8370. That one means we are accurate. Let's go to the next. Unaona next. Hakuna journals. There is no journals today. Actually, it's also good to know how to do it without passing the journals. Huh? We can pass journals for fun later, but let's see how do you go about it if the journals are not requested. So right there, Trigger. Now this is Trigger Limited. Trigger Limited. Trigger Limited. Statement of financial position. wanajua cash book inatokea shida. Hiyo cash book. Na nitajua hivi. Ni the comes. All right, so we kick off.
Because I can keep for once that you can hold, there must be something affecting us.
Zipo for me.
So because times when you
Wewe kwa nini hujasahau na hujaanza? Si ndio hii umekumbuka? So there's no way you will forget.
because when you open, the balance is like to be there among the time.
So sawa, wewe unaweza fungua uweke entries lakini itakupea marks. Lakini unaweza tumia ujanja hapa bado uipate. Acha tuone kama ujanja nitaelewa. Usipoleta tutafunga. So on current assets, the taken over values. Now you go to note number which one? 8. Record those taken over. So land and buildings. Land and buildings, we have 2880. Land and machinery. Land and machinery, 1770. Furniture and fixtures, 510. Investment, 190 visual, 7,400. Then Goodwill might be around that. Tumeruka journals. Sikuruka, usiwa kutuuliza. You don't imagine kutoka hiyo journals yote then it is 0 marks. So Goodwill. Ruka hiyo. Current assets. Current assets, inventory. Inventory, they say they took it over less what? At book value less 10%. So we take what percentage? 90%. So check the book value of inventories, then take 90% of the value. So inventories, 90% of that figure, 877, 500. Then receivables less 5%, so that is 95 of receivable. Where are you? 858. 858. So 95% of that. 815. 100. Then your cash. Cash iko na story mingi sana. Cash, they are saying cash at bank at book value, but you see we will reconcile. The reconciliations. Kuna cash which were affected. So what you do, so this one we can't get. You post things that makes you happy. Kwani hata hiyo kitu ni max ngapi? Si ni 6. Kwani hizo entries zote hiyo cash ndio itafanya wewe endelea. Equity and liabilities. Hold on. How much or how many or how much? Ordinary shares and preference shares did they form the company with? Check note 1. In note 1, it was formed with authorized share capital of 600 million, ordinary shares of shillings 10. So when you multiply that, 6 million.
Yes.
And preference 40 by 100, also 4 million.
Yes.
Then read this note. Read note 10. You know they have been giving out shares.
Yes.
We don't use authorized in any accounting until they are issued. But read note 10, trigger issued for cash and at par all the remaining what? Ordinary shares and preference shares not issued as part of the settlement of purchase consideration. So you know they were giving. So that's from trigger.
Yes.
Then the ones which remained, they said they gave out for what? For cash. So it means when they are forming, ordinary will be 6 million and preference will be 4 million. So I'm trying to yes. So ordinary share capital 6 million. Preference share capital also 4 million. Yes, 4 million. Then check non-current liabilities. Non-current liabilities, there is a debenture which they gave out somewhere. Oh, 1.2. Check the 4% debentures account. There was debenture which they gave out. So they gave out 6%. 6% debentures. Check your debentures account. It was 1.2. Then check for me the issue of current liabilities, the ones which were acquired, so that we be sure of them. Check current liabilities in the books first, so that we know how many they were and whether they were acquired. Trade payables and accrued debenture interest. Trade payables, there was a story. Dot number 6. Dot number 6. 7. In note 7, they said trade payables will be taken over by the new company and immediately settled by issue of fully paid ordinary shares. So fully paid. So come on, a balance of ordinary, it means inclusive. So how they were settled by those shares to Konazo, they are part of that. So ordinary payables out. Check for me accrued interest in note 6. Interest accrued, are you seeing that?
Yes.
Interest accrued on debentures will be paid in cash. So it means when reconciling our cash book, we'll credit the cash book with the interest. Sure. So that is paid. So there is no current liabilities. Add this. This is the total equity liabilities. How much? Yes. 11,200. I wake up 11,200. You need to do side. Then what you do, we want to calculate goodwill. So I have a working outside for goodwill. They say, well, if you are you 4 million. That's what they say. Well, if I'm Kafui now, how many authorized? Check note 1. I see 40 million. 4 million. How many preference? Shares, multiply by 100. Then we are working in thousands. So it is 4 million. Then we just somebody wameharibu story rahisi. Huko chini wamesema all the remaining, you know they have been issuing. Then the remaining pia wakapeana. So it means all the preference, all the ordinary were given out. Yes, it is 6% now. Yes, this is 6%, not 8. This is 6%.
Can somebody don't deny you because they get like 6%?
Hata wasomaji hizo vitu. Mko na grammar. Na grammar hizi figures. Ukimark 10 scripts, unajua hizi vitu. Kwanza unaanza na hapa, unajua kuna 6 and 4. I want us to calculate goodwill. I'm planning to fix up the cash book, but subject to workings. So goodwill, how do we get goodwill? We will take the purchase consideration. So purchase consideration was how much? 60 what? 63.48. Sure. Yes. Less net assets. Net assets acquired. Net assets acquired. So net assets, I'll take the assets. I'll take all the assets acquired. Assets acquired, then I'll subtract liabilities. So kindly do for me this. The assets acquired, add these ones. Check here. Add this. Then cash, they say they acquired at book what? Book value. So add for me this one. Then cash is the one you bring. It was 271,200. But here I can't bring that because of the reconciliation. So can you add for me this, including the cash? I want to see the answer from online as well as Yenyu. So add all the assets which were acquired because we consider the taken over values. So add all this plus this, including cash, 271,200. Once you have an answer, please let us know. If you have the answer, you just say. Huh? They will confirm. You get?
That is assets acquired.
7. 7, 3, 2, 1.
200.
Many people are getting that. Huh?
Yes.
Even online. Liabilities. So less liabilities acquired. Liabilities acquired were only those two. They acquired payables and accrued what? Interest. So just add them at book value. That is 876 plus 144. Are you seeing that? Yes, they were acquired at book value. Settlement per day. So this is 1020. So subtract this to get the net assets, which we will subtract to get goodwill. So 7 minus that. Already Rogers is giving me an answer. 6301. 6301 200. Even it's giving me goodwill to be 46,800. So goodwill is 46,800. That is the goodwill. So can you bring goodwill up here? 46,800. Then add for me the non-current assets, all this here. Total non-current comes to 5404. Confirm? Yes. So what I want us to fix the cash book, but we do a reconciliation to confirm. So can you fix for me the cash book? In exam, we shall fix the confirm. So take 11,200 minus this 2. 4. 4. Get around 100 million in book. 4. 43. 4103. 200. All right. So, Wisha, in exam we maliza. Can we confirm? Let's open cash book. So open your cash book. It is good to confirm. To make the heart feel happy. Yes? So, mimi hapa unaniweka to confirm. Hii uta confirm kwa kile. Hakuna hiyo time. So cash book. Let's come up to the cash book. We check whether we get the same. So cash book balance goes down. The one you acquired from that company, it was how much? 271. 271. 200. Now that. Then first of all, let's concentrate on what they paid in cash. So you go through the notes. You tell me check this note, check this note. The ones which were paid in cash. Ile ya dissolution, eh? Yes, ile waliwapea dissolution cost was 30. Was 30. That one I agree. There's another one. There's something which was settled in cash. It was payables walipewa ordinary shares. Accrued interest, eh? Yes, accrued interest, they said. It was not number 6. Yeah, they paid that one in cash. So accrued interest. So how much was the accrued interest? 144. 144. Was there anything paid in cash again? No. So let's go for the cash receipts. One, they said all the remaining ordinary and preference were given out for cash. So to get the remaining ordinary, so come here and say ordinary share capital, the remaining. Remaining means the total minus the ones they have done what? Issue. So the total was 6 million. 6 million minus, I remember, go to Trigger. Trigger, they had been given a total of 30. We check Trigger limited account. The total shares which Trigger gave out. 30. Yeah, so 30 was given. 30. Also, they gave out some shares to settle payables. Sure. Yes. So these ones were given to Swara. Then payables, check payables in the books, in the balance sheet. It was 876. So this is payables. Payables were given this. So the balance should be that difference. So can you check for me that balance? Comes to 2094. So bring here 2094,000. Preference the same. Preference share capital total was 4 million. Minus, check for me Trigger account. Trigger gave us how much? 2088. So they gave out 2088. Then I'm going to give them. So just the difference. So can you get that difference? Difference comes to 1912. Can you reconcile that cash book? Check if the balance carried down is what we have fixed up there. For 4103,200. Yeah. Then we are okay. So 4103. Why would you waste time doing that cash book and it will not add you anything? Where things is on? What if? What if customer also use one like when a journals? Sinawezekana. Unaweza leta hivyo. So nielekea hapo chini. Tuandika hapo chini journals for fun, eh? Let's just do it on assumption what if. Ama unaonaje situfanye? Let's do it on assumption that journals was to be prepared. So andika hapo chini journals for fun. Usiende kwa mtihani kufanya kama hujaitishwa. But according to examiner, that is what you are supposed to do. So can we have journals for fun? Hiyo kitu si baya. Jana ulikuwa na hii rula kweli? So I want us to do the journals on assumption that it was required. Assumption that it was required. So write their journal entries. Wewe uandike venye utaandika because mtu anaweza chukua kitabu yako akuulize kwani journals is a must even if not required. Journal entries. We kick off. So tell me, I want you to guide me how to go about it. The start. I want you to give me the start. How do you want us to start? Debit all the assets in the journal, then you credit business purchase account. So all the assets are the taken over values. Are taken over values. So we have land and buildings. 2134 200. After you finish. Because hakuna masomo mengine involving kama hii. But unless you go to another professional course. Unless CFA sasa nimeshika. But the rest hakuna. The rest hakuna kitu cha kusumbua. Usikia venye naongea vibaya. Hizi sura haikai kurudi shule. Nataka kwenda wapi? Imagine you will miss class.
Amen.
Even if it's for fun, eh?
Just to give the people doing it part of that.
No, Ama. Nimerecord book one. Charles, where do the best go? I record this very fast. F and F, 510. Investments, 197. Inventories, less 10%. But now we can 90%. We can't. It was how much? 500, 90%. Receivables, 95%. What did we get? 815, 100. Cash at book value, the way it is. So cash name 271, 200. So credit business purchase account with the total assets which you have in your balance sheet. How much? You got a balance, but it is coming to 10, 20. Cash, we are gas, so before that. So add that, then give me the figure. Ali amesema yeye akimaliza atakuja kufunza AFRA. Ali karibu. So how much? How much is this? Yeah? 72? To record the assets acquired. Number 2. Number 2, what do you want us to record? Let's bring the liabilities. Let's bring liabilities. So liabilities, just reverse this. So business purchase account. Leave it hanging, break the liabilities. There were only 2, and they were at book values. So trade payables. So payables, 876. Then accrued interest, 144. Total, 1020. Record the liabilities taken over. Number 3, what do you want us to record? What do you want us to record? Purchase consideration. So debit, business purchase account, business purchase account. Then you credit SWARA as a creditor. SWARA limited account with the purchase consideration. It was 63, 48, 348, 6348. To recognize or to record purchase consideration. What else do you want us to record? How we settled. So how we settled, you reverse the transaction by debiting SWARA, then you tell us how it was settled. So debit of SWARA, SWARA limited account, 6348. Hata hii kufunza si rahisi. Najua tuko na some teachers around. They can confess. Teaching is not all about knowing it.
Yes.
It has so many issues. Kusimama hapa mbele si rahisi. Then hatutapa mask. Unapoandika hapa 6348. Ule msichana ako huko mwisho anang'ang'ana anafunga jicho kuangalia. Mwalimu akiona jicho imefungwa anafikiria ni yeye amefungiwa. Balancing figure inapotea. Alafu at the end of the day, unabikiwa kitu baya. Very incompetent. It is not that easy. It is not easy. Agenda is baba hiyo. So they settled by giving ordinary shares 30-30. They gave out 6% preference share capital. 28. Yes, it was 20-28. They also gave out cash. They gave cash 130. I remember they also gave out 6% debentures. 1.2. 1.2. That is how they settled that purchase consideration. Which number 5? What do you want us to record? Goodwill. But now you took us to record debit, goodwill, credit, business purchase account. However, goodwill, the purchase consideration is this minus net assets. Net assets is this minus this. This minus that purchase consideration. Right. Then now debit goodwill account. So goodwill. What? 800. Record goodwill on acquisition. So now, in a by the way, upon number 5. But now you record other things you deem necessary. The things which you deem necessary, number 1, payables. Payables for the payer shares. Do you remember? Payables were given shares to settle their balance. So that is a journal you need to pass. When you give out shares to payables, reduce the liability, so debit payables, then you credit ordinary share capital account. So payables, what was the balance? 876. 876. Ordinary 876. You can say to settle trade payables. Then next, they also settled accrued interest, but in cash. So credit the cash book, debit the accrued debenture interest. Accrued interest was how much? 144. Then cash book 144. Number 9. Number 9, I think that one should be ordinary. They say they give out all the remaining ordinary for what? For cash. So debit the cash book. For cash book, all the remaining, you check the total. Total was 6 million minus. So check your journals, all the shares they have been giving out, ordinary. Number 1 was the 30-30. Get it here. 876. So this one was given for cash. How much is that? 29.4. Credit ordinary share capital account. Cash book again for preference. Preference was 4 million. When you check your journal number 6, they have given out 2088. Then you credit the 6% preference share capital. It was how much? Yeah? 1912. Pusha. That is how your journal should be. Huh? Is there? Oh, sawa. Number 6, sawa. Number item. You can even fail to number them. You can even fail to number them. There will be no problem. The only assignment I'm leaving you with for reconstruction is May 2018. Recap of May 2018. May 2018, question 2B, internal reconstruction. That is internal. You check that question. Prudence will answer you. Question 2B of May 2018, internal. So at your free time, that's it. Prudence is asking, there are somewhere the examiner saying that they were giving them credited at 5, then they will pay the balance. But now you know what will destroy Kizungu at the time, all the remaining. So when you say your cash book, so if they never gave everything, I could have multiplied by 5, like yesterday. But now here they say all the remaining. So prudence, they are all inclusive. What remains, because they are supposed to pay cash. In your honest opinion, see, those ones are enough for reconstruction. If you can't, which is impossible, come with the level is so that those 3 are enough. You can revise with them every now and then, it will be fine. So internal, make sure we just have internal. Many people are highly expecting external reconstruction, but examiner in hand, then they can do the opposite of how you are thinking. So make sure we believe you. So I'm giving you a break. When we come back, right, for me there IS 33. IS, that's a topic. That's number 33. Earnings per share. Opil knows what? Yes. That is earnings per share. Evening, we have done how many questions in cash flow? We have done 1. Early morning, we have done how many questions in cash flow? 1. Okay. Today we have done how many questions in cash flow? 2. So I want to find it at that. So Once we are done with cash flow, we do impairment. Impairment is not that big. We do impairment. Hii tutakuwa tunafanya kwa hizo Sundays zimebaki. We're remaining with 2 Sundays. Tutakuwa tunapumzika na hii atumaliza. So once you are done, you'll be okay. So how many minutes break? 5. Then we come back. 5 will be enough. How much time? Let's convert back at 11:30. Are you sure in the prayers?
Yes.
So have a break up to 11:30.
Yeah, I know. I don't see.
But when Sri Lanka. Those people are mad. EPS, earnings per share. It is the earnings for every share. So right here, I'll say, the objective of IS 33, Alafu, we are writing these notes from the back. So kuna watu wengine mtu anasoma tu kidogo alafu anasahau kulikuwa na zingine nyuma. Kama hiyo topic ya kufanya. So when you are reading, always check the back. The back of the book. You can forget. So right there, I'll say the objective of IS 33. The objective of IS 33 is to prescribe the principles. The principles for determining and presenting earnings per share amounts to improve performance comparisons between different entities, in the same reporting period, between different entities in the same reporting period, and between different reporting periods, and between different reporting periods for the same entity. For the same entity. And between different reporting periods for the same entity. Full stop. The main purpose for EPS is just for comparison purposes to check your performance, because the higher the EPS, the better. So you can check against within the company and for the competitors within the same industry. Scope of EPS. Scope of EPS. Scope of EPS. So which entities are required to present EPS? We say IS 33 applies. IS 33 applies to entities. Applies to entities. Entities whose securities are publicly traded. Whose securities are publicly traded, or those which are in the process, or those which are in the process of issuing securities, those which are in the process of issuing the securities to the public. Issuing securities to the public. Full stop. Another item. If both the parent and consolidated statements, if both the parent and consolidated statements are presented, both the parent and consolidated statements are presented in a single report, then EPS is required. Then EPS is required only for the consolidated statements. It's required only for the consolidated statements. Full stop. So when you have consolidated books and the parent's books, EPS is only for the consolidated financial statements. Key definitions down there. Key definitions. Key definitions. Number one, ordinary shares. Ordinary shares. Stroke. They are also known as common shares. Common shares. Stroke. They are also known as common stock. Ordinary shares, stroke common shares, stroke common stock. Then you say, are equity instruments. Are equity instruments. Are equity instruments that are subordinate to all other classes of equity instruments. I repeat. Are equity instruments that are subordinate to all other classes of equity instruments. All other classes of equity instruments. Full stop. Number two, potential ordinary shares. Potential ordinary shares. Potential ordinary shares. You say is a financial instrument. Is a financial instrument or other contracts. A financial instrument or other contracts that may entitle its holder to ordinary shares. Entitle its holder to ordinary shares, e.g. convertible debts, convertible debts. Next, convertible preference, convertible preference. Finally, options. Options. Why are they potential? They are potential because they have capability of being converted into ordinary what? Shares. Dilution, the next. Dilution. When you say a reduction in EPS, a reduction in EPS, or an increase, reduction in EPS, or an increase in loss per share. A reduction in EPS or increase in loss per share. So when EPS goes down, we talk of dilution. When it increases, we talk of increase in loss per share. If it goes up, that is also dilution. Anti-dilution. Anti-dilution. Anti-dilution, you say, is an increase in EPS. Is an increase in EPS or a reduction in loss per share. Reduction in loss per share. Next, contingently, from the word contingent, contingently issuable ordinary shares. Contingently issuable, contingently issuable ordinary shares. Then you say these are ordinary shares issuable by an entity. Ordinary shares issuable by an entity upon satisfaction of certain conditions. Upon satisfaction, I say these are ordinary shares issuable by an entity upon satisfaction of certain conditions by a third party. By a third party. By a third party. Full stop. Kuna hiyo swali nimewachia internal reconstruction. Part A, it was question 2 or 3. Whichever question it was, part A of it nimeona kitu kama hiyo. Hebu check for me, it was which question? May 2018, eh? Question? It was 3. 2B. So hebu check for me too, eh? There is something I saw in EPS. EPO reform. Eh? What did you issue about na ingine? Dilution, eh? So they just wanted the definitions, eh? So dilution is the reduction in EPS. When EPS goes down, earnings per share goes down, then that one is dilution. Or it can be increased. When the loss is going up, increase in loss per share, that is also dilution. Then contingently, contingent means subject to. So the other party must satisfy certain conditions for them to be given those shares. Those are called contingently issuable. It means the issue of those shares to third parties will depend on certain factors, future factors. Types of EPS. It tells me, but I think types of EPS. What do we scare? Types of EPS. Types of EPS. So EPS, we have 2 of them. Number 1. We have what is called the basic EPS. And number 2, we have what is called diluted what? EPS. So basic, we'll be sometimes calling it this way. Whatever kuna shida ya B na P. Ya kuna watu na P ni B, in all instances. So let's start with basic EPS. Let's start with basic EPS. Basic EPS, you say, is a form of EPS. Is a form of EPS. Form of EPS, which is determined by dividing. Form of EPS, which is determined by dividing profit or loss. Dividing profit or loss attributable to ordinary shareholders. Profit or loss attributable to the ordinary shareholders of the parent company. Ordinary shareholders of the parent company. Of the parent company. With or by, no, it should be by. Dividing profit or loss attributable to ordinary shareholders of the parent company by the weighted average. By the weighted average. By the weighted average number of ordinary shares. Weighted average number of ordinary shares outstanding. Outstanding during the period. Outstanding during the period. Outstanding during the period. Full stop. So down there you say basic EPS. So we are writing that formula. Basic EPS. Basic EPS is equals to profit attributable to ordinary shareholders or equity holders, ordinary shareholders, divided by weighted average number of ordinary shares. Right. So when we step our legs in the exam and we get EPS and they want basic, then that is the formula you will be applying. So in short, which I want you to have in short, the formula is this way. Block that one properly. Alipopote unatembea. Tembea now. That's what is equals to what? Yes. Basic EPS is powers over one-offs. So powers is the profit attributable to ordinary shareholders. Then one-offs. Hakuna mtu amefanya EPS ati one-offs. Lazima tu itabidi umejua that word. In fact, there is sometime wa group, unajua during WhatsApp hiyo time WhatsApp ilianza kushika. Unajua hata mtu asipoweka kwa group mtu alikuwa anateta, sio? Siku hizi hata group unataka tu utoke, sio? Hata ukitoka uweze sema return hakuna haja. So people were very active. Anything posted in the group you must read. Nowadays, do you even check? Hata una mute. So tulikuwa nafuatilia, tulikuwa kwa group na section 6, unaona pale mko section 6. So kila kitu kipostiwa. So nilikuwa naona watu wana discuss. People used to discuss in the groups. Hizi watu wamekuwa vichwa ngumu. Walikuwa na discuss wa group, mtu anaweka swali. So huyu ana handle not 1, not 2, not 3. So naona watu wakisema hiyo imekuwa ngumu. Ask one-offs. Hiyo ni ngumu, ask one-offs. Kumbe ni mimi nilipewa hiyo jina. Without knowing. They had given me that name. So I was wondering, how is one else applicable here? So I hope you will not give me that name. Let's start with the powers. Let's start with the powers. Powers, you say, other powers hakuna story. Let me just give you the formula. It will not be an easy road kama FM unatoa your profit. Here you have to struggle to get it. So powers, I'm just giving you the formula straight on how to determine that profit. So you say here, powers, you take the reported profit, reported net profit for the period, of course. Then you less stock earned. So here it depends. Extra ordinary items. I'll tell you what they can be. You add less depending. Then you less profit attributable to NCI, if they are there. Then you less preference dividends. Preference dividends, you subtract. Then what remains is what goes now to the owners of the company, attributable to ordinary shareholders. So that is how you'll be calculating it. So those extraordinary, Alice is saying that is a good name. Extraordinary, they depend. And they are not constant. That examiner will not open up that much. Extraordinary, they tell you that the item which was added related to the previous financial period. The one which is common is preference dividends in what? In arrears. In arrears, those dividends were supposed to be expensed in those previous years. So zikiwekwa hapa, kazi imetolewa, add them back to rectify your profit. So here the examiner will just guide you. They will tell you that they were added, those they related to the previous year. So you can subtract, depending with what they did. Then, if minority are there, you subtract. Preference dividends, you subtract, then you get what goes to the ordinary. By the way, something you should know. Kuna watu wanakwanga sumbua, kesho mtu anaenda kwa ofisi. I want to know, why are we not been calculating EPS? EPS is only mandatory for companies which are what? Yes. Put it in the stock market. These other ones you can calculate if you wish to, but it's not mandatory. The ones which must, and this one, and any company quoted must be group of companies. So, yes. Next, one-offs down there. One-offs. Then you say, these are ordinary shares. These are ordinary shares. These are ordinary shares weighed. Ordinary shares weighed for time factor. Weighed for time factor based on the period. Based on the period when the shareholder was entitled. Based on the period when the shareholder was entitled to earnings. The shareholder was entitled to earnings, stock dividends. Earnings, stock dividends during the period under consideration. During the period under consideration. Full stop. Full stop. Just a minute.
Yes. Ni nani? Time factor. Based on the period. Based on that. When the shareholder
Sorry for that. So let's say you were 3 shareholders before. So the year starts in January, ends on December. You have 1 million shares. Then there's another shareholder, you have given them shares, maybe in April. You give out 200. Then we are closing in December. And December, we want to know the profits. So when you want to know the earnings, that is, when you want to know the EPS, I'll take the profit, fine. But the shares, you will not just take a million plus this. That will be wrong. Because we have a katikati. So we would away. Kama amekuja 1st April, you wait for how many months? 9. Then these ones are entitled for the whole year. So down there, write for me illustration. All right, so with illustration, the following was the capital structure. The following was the capital structure. Ngoja kwanza, mmeelewa the concept of wait, once. Yes, you check the period that person is entitled to earn. The following was the capital structure of ABC Limited. On 1st January 2021. On 1st January 2021. So the capital structure we have. Now let me come up with it. So have this capital structure. So we have 7%, 100,000 preference shares at shillings 10. This is 1 million. Then we had 100 ordinary shares also at 10. That is another 1 million. So in total capital structure, we had 2 million. Have that. Have that. All right. Additional information down there. Additional information. Additional information. Additional information. Additional information. You say the company reported profit after tax. The company reported profit after tax. That's additional information number one. Eh? Okay, reported profit after tax of shilling 700,000. Of shilling 700,000 for the year ended 31st December 2021. For the year ended 31st December 2021. We'll stop. Number two. Number two. On 1st of June 2021. On 1st of June 2021. The company issued. On 1st June 2021. The company issued 240,000. Issued 240,000 new ordinary shares. New ordinary shares at full market price. At full market price. Full stop. Required. Calculate the basic EPS. Calculate the basic earnings per share. From that information you have. Yes. So based on the formula I gave you, are you able to work that out? I read already the question. So let's check on that. Always write the formula, though we know you know the formula, but always start from there. EPS accounting, finance department procedural. Everything you write will count. So let's start with the formula. You say, I'm going to record. Recall that basic EPS is equals to what? Powers over what? Though powers kuna watu wanatumia hizo jina in types differently. So usiende kwa exam room mtu akushtua ati wewe unajua kuna watu niliona wanaita yes. There are people who write it this way. Earnings. Kuna mali. Earnings attributable to ordinary shareholders. Na mwingine anasema so profit attributable to ordinary shareholders. Profit attributable to ordinary. So usiende kwa mtihani unasikia watu wako kwa kona wanasema wameiva. Unashangaa kwani subject gani leo? So shika hiyo naye. So we have powers over ones. So let's start with powers computation. Let's start with powers computation. Powers computation. So shillings are in thousands. Let's reduce them to thousands. Those zeros are clean. So reported PAT, reported profit after tax, Engapi? Okay. 700. So they reported 700. Then you less. What do you want to less? Preference what? Dividends. Some people come and subtract preference shares, the dividends. So preference dividends, they were being paid at what rate? 7% times the value in monetary was 1 million. So 1,000. That one will give us 70. So we subtract 70. So the profit which will go to ordinary is 600 and what? That. So have that. Then now let's go to one-offs. One-offs computation. Let's go to one-offs. One-offs computation. So one-offs. One-offs computation. You say here date. Say here details. Say here what? Shares. Say here weights. Then you tell me one-offs itself. Like that. Have that. All right, so you start from the beginning of the financial period. Beginning of the financial period. So beginning of financial period is 1st of January 2021. 2021. You say balance brought down. Details is the balance brought down. How many shares were in the capital structure? Ordinary. You check ordinary, not preference. 100,000. So you bring here 100,000. No. Yeah, number of shares. We are working in thousands. So I can write 100. Sure. The number of shares, not in monetary shares. 100. Then weight you check. These holders during this year up to December, they'll be interested or entitled to earnings for how many months? So 12 months. So weight is 12 over 12. They'll be interested for the whole year. So one-offs will be 100. Then kuna watu walipewa shares. In which month? Which date of which month? 1st of June 2021. You can call them new issue. They were how many shares? 240. So 240. So with them, they'll be interested or they will be entitled to earnings from this date when they join. So from June up to December, how many months? 7. December 12 minus 6. So that is 7 over 12. 1st June, coming in 30th, the 6 months. 1st June, those are 7 months. So they are interested. So you take 240 by that. Copy? 140. So this is 140. So the weighted average is 140. Therefore, You can close it off. This is 340, but the weight of 340 is an equivalent of 240. Yeah. So that is your one nose. Therefore, I think therefore serious opportunity. Therefore, basic EPS will be the powers which you had already calculated at 630. 630 divided by 240, giving us shillings. How much, ladies and gentlemen? 2.6. Yeah, so you get shillings 2.6 per what? A share. So for every share you have, you are entitled to receive earnings of 2.6. Haya, tunasonga pole pole. Mpaka hapo tuko sawa? A problem arises here. Which problem? The problem which normally comes up. Najua group haipatiangi amani. The parent company, we are not writing. The parent acquired subsidiary on 1st January. For example, 1st January 2021. But they never paid cash. You can acquire by issuing what? Shares. So they acquired by giving out shares. But you know very well, share transfer is always a process. There is the legal process you have to follow. So the acquisition took place here, but the actual date when they transferred the shares, let's say the actual transfer took place on 1st July 2021. So the question which comes up, do we weigh these shares from 1st July or do we weigh them from 1st January? This was the date of acquisition, but this is the actual date when shares were transferred. So when do we weigh them for time factor? Tuandike before tuanze kufunga macho. That's right. You say shares issued as part of purchase consideration. Shares issued as part of purchase consideration. As part of purchase consideration should be weighed for time factor. Should be weighed for time factor from the date. Weighed for time factor from the date when the investee, company, from the date when the investee company was acquired. Underline that one, acquired. The date when the investee company was acquired, but not from the date, when the shares were transferred. Not from the date when the shares were transferred. Full stop. So, so when you find the question, the date of acquisition and when the shares were transferred, weigh them from the date of what? Acquisition, which makes sense. Ukiwaambia ati I will be entitled to earnings when you give me the shares. So another delay your transfer of shares. Wanakuzungusha hivi. So from the date of acquisition, that is when you are entitled to earnings. Subtopic. Issue of shares, that is subtopic. Issue of shares. Issue of shares. Without changes. Issue of shares. Without changes in resources. Without changes in resources. In bracket shares. Without changes in resources, in bracket shares. Haya. Hiyo inakuwa something very funny. Andika hivi. This arises when either of the following takes place. When either of the following takes place during the financial period. Takes place during financial period. During the financial period. So 1, bonus issue. Bonus issue. Number 2, share splits. Share splits. Number 3, reverse splits. Reverse splits. And last, rights issue. Rights issue. Your rights issue wanaweka hapo mbele. Waandike customer wanapenda sana. Your rights issue. Whenever they bring EPS, rights issue will always be there. So we say that there is no change in resources because when you check them keenly, bonus issue, what is bonus issue? There are shares given to the existing ordinary shareholder, actually for free. So there are no shares which are coming from out. Within a two, unawambia 1 for every this. When you check share split is just the reduction in par value. If you have one of 10 shillings 10 each, make them to be 2 of shillings what? 5. You split them. Reverse, you take 2, you combine them to be 1. So the shares economy. Rights issue the same. You just give the existing shareholder shares at a price lower than the market value. So there is no new shares coming from out. So the problem which arises, people do complain. Wanasema unatupea bonus because you have worked here very hard. So when do you want to weigh? Actually, in all those, the definitions will not be very important for us. What is going to be very important in those 4 is how to weigh them for time factors. Because these shareholders, they were there from January. In July, you are telling them we want to give you what? Bonus. So are you giving us bonus and you weigh them from July onwards, or you will weigh them from when we were present? That is where the question comes. So let's handle them one by one. Let's start with bonus issue. Let's start with the bonus issue. Bonus issue, sometimes it is called share capitalization. So stock share capitalization. Share capitalization. We some people can even call, they can call script issue. What only bonus? I want a script. I'm a script. Kuna T, ndio? Hakuna T. Okay, so we are big up machine. You say, is the issue of shares for no consideration? Issue of shares for no consideration, in brackets, for free to the existing ordinary shareholders, to the existing ordinary shareholders, in proportion to their shareholdings. In proportion to their shareholdings. Full stop. Another item. Bonus shares are considered in full. Bonus shares are considered in full in the one-ounce computation. In full. In the one-ounce computation. In the one-ounce computation. i.e., they are not weighed. They are not weighed for time factor. They are not weighed for time factor. They are not weighed for time factor. We don't weigh bonus. Bonus is not should not be very conditional. When you tell people you are giving the bonus, najua hata hapa inaletanga shida. Januari ikifika, watu wanapewa bonus. Kuna wengine wanataka kukalkuletiwa bonus on the gross. Wengine wanataka kukalkuletiwa on basic. Kuna difference ya basic na gross, ndio? Then ati wewe ulikuwa absent last year for 6 days, wanakukata. Unapata the same salary in the same department, lakini neighbor amepata more bonus kushinda. Have you ever seen those issues? Yes. So bonus should not be that conditional. If you are giving people bonus, give people bonus. So bonus shares when we get them in the question, ukijisikia sana, hiyo weight inakusumbua, weka 12 over what? 12, ikuwe 1. So ukimultiply na 1 tuone kwenye utafika. So bonus shares, you don't weigh them for time factor. So tukifanya hesabu utaona tu watu wanasema 12 over 12. And you are wondering, these people were there from January, now we pay bonus September. So we don't weigh them for time factor. Share split. Number 2. Share split. Share split. You say, is the reduction in par value. Reduction in par value. Reduction in par value. Reduction in par value of ordinary shares. Par value of ordinary shares. Full stop. The main objective is to make shares more affordable. Is to make shares more affordable to the existing ordinary shareholders. To the existing ordinary shareholders. However, this may have dilution effects on EPS. However, this may have dilution effects on EPS. Dilution effects on EPS. Full stop. So, share splits, kama ni share moja, unaona ziko expensive, you want to raise more funds, na mtaki kuita watu wa nje. So this one was 1 share at shillings 10. We can make them to be how many? 2 or shillings 5, so that many people can subscribe. Existing, they can subscribe. The only issue, the one will not change. But now the problem, if people are making, they can interfere with the EPS. Another drop. Next, reverse splits. The issue nimesema si mambo ya definition, how to weigh them. And now because share split and reverse are weighed the same way, tuandike reverse then tuandike NB ya kushika zote mbili. So you say reverse split is the consolidation. The consolidation. It's the consolidation. Is the consolidation of ordinary shares. Sorry, of par value of ordinary shares. Sorry, is the consolidation of par value of ordinary shares. Par value of ordinary shares. Full stop. The main objective is to make shares more expensive. More expensive in order to avoid the dilution effect. In order to avoid dilution effect. Full stop. So you scare people who think they have money from just buying shares of your alafu shares the end. You know, increase in shares will reduce CPS. So you make them very expensive. So kama ni moja ya 10, make them to be, yes, like you put a bill of 10, you make them to be 1 at what? 20. You scare them. They say those things are expensive. NB down there. NB. Both share split and reverse split. Both share split and reverse split. Both share split and reverse split are weighed for time factor. Are weighed for time factor in the same way as bonus. In the same way as bonus. In the same way as bonus. Right. So unafikiria utakuja hapa kukata share zetu zikuwe cheaper, then you tell us now you weigh us from that date. No. you weigh them for the whole what? The whole year. Because the argument is, when you are calculating EPS, you ask yourself, this shareholder, he or she was entitled to earnings from when? This person has been there. Then now you are coming to split them in October. Then you tell them for 3 months, October, November, December. They will not agree. So to entice them to accept that deduction, please weigh those shares from the earliest reported period during that year. So bonus, split, reverse the whole year. Actually, if you want, you can even fail to weigh them. You just take them the way they are in the one-offs. So ikibidi you weigh, you multiply by 12 over 12. Because I know what will happen. Why are you taking 12 over 12? Unaona watu wanahesabu. Make sure umesikia hiyo maneno. Vizuri. Let's wind up with rights issue. Rights issue ndio kasi wanapenda every question. Others last sitting there was CPS. And check for me which question. Kama kuna rights issue, then that is a bad question. EPS is not complete without rights issue in the eyes of customer. And we check for me last sitting. EPS was which question? Question number 3. Question 3C. Guni, on 3C. 3C. So where the two additional information? What are anything additional information? Just land on note 1. On 1st January, the company issued 1.8 million ordinary shares in a 1-for-5 rights what? Without rights issue, EPS is not complete in the eyes of customer. So rights issue, almost all those questions kuna rights issue. Na kuna reason wanaelekana juu kuna kitu nasumbuanga wanafunzi hapo. But provided you are from Alliance, utaielewa. I'll tell you what it is. So right there and say, is the issue of shares at a discount? Dennis. Hii jina Dennis naona imeanza kukua common. How many Dennis do we have in this class? So you are Dennis. Is another Dennis there? I'm also Dennis. So please can you just call yourself Dennis for the purposes of this exam? Is the issue of shares at a discount, open a bracket, you say, at a price lower than the fair value. A price lower than the fair value of the shares. A price lower than the fair value of the shares. Close the bracket. To the existing ordinary shareholders, in proportion to their shareholdings. In proportion to their shareholdings. Your story of proportion means 1 for every 2. That is the proportion we are talking about. In proportion to their shareholdings. Full stop. Another hyphen. The main concern. So start being serious about the main concern. The main concern is that theoretical ex-rights price. Theoretical ex-rights price. Theoretical ex-rights price. We'll be calling it TRP. Theoretical ex-rights price should be adjusted for. Should be adjusted for. Full stop. Another hyphen. TRP, that is the theoretical ex-rights price. TRP is the average market price. Is the average market price which the shares had been previously. Average market price which the shares had previously been valued, previously been valued prior to the rights issue. prior to the rights issue. Prior to the rights issue. Full stop. So that is hiyo tu ndio inafanyanga walete rights issue. There is something called theoretical exercise price. Actually, what I compare from Chani, I've never seen any exam them giving the exercise price. They will not give you. So what happens before you give rights? The last I checked, I think, 2019, in Kenya, prior to the rights issue, you must notify the CMA and stock markets 6 months prior to the rights issue. And even the public, you have to notify them. What's the rights issue without public notification? As I was saying, 6 months prior to. So you tell the stock market, we plan to give 1 million shares and the rights issue in December 2022 at maybe shillings 18 each. Fine. Come the actual day, price may change. The price of the shares due to those fluctuations in stock market, the price is now 16. So these shares in your books, so this price which you are presented prior to, this is the theoretical. So in your books, shares were valued at what price? 18. Now the actual price in the stock market is 16. It means you must adjust your books to take into effect that theoretical exercise price. So write for me down there how you calculate it. So TRP, actually it should be TERP, not TRP. This is how you will be calculating it. You take a structured formula. I will just give something. Then we find actually one question. So write for me X new shares at shillings Y. You get P. Then Q old shares at shillings. Which one? Somebody, whatever. Endless. Z. Giving us B. So here you add X and Q. You get XQ shares. Then here you get total shillings PB. Therefore, X rights will be the shillings average PB divided by XQ. That is how you will get theoretical X rights price. With one question, you will understand. They'll tell you through the rights, you will get 2 new shares at shillings 20. Then for every, you get 1 new for every 2 you have. So for every, the ones you are having, those are the old share. Then these ones are this price. So Y, I think Y is the exercise price. Y is the exercise price. Y is the exercise price. While Z is the come rights price. Come rights price, i.e. the price on the date or as at the date of the rights issue. The price as at the date of the rights issue. So the examiner, they are very mean. They will not give you this rights price. The price at which the shares have been presented to stock market, the intended price, they will not give you. You will have to calculate it on your own. So you take how many shares are you getting, at what price, how many were there before the rights issue, and what was the actual price on that day. Then once you get the exact price, this is how you will get one-offs. So down there, write for me, one-offs. One-offs will now be determined as follows. One-offs, you will now get it this way. There are two formulas. Let me give you one. So then we can check another one. You take ordinary shares before rights issue. You multiply by the CAM rights price over the X rights price, should be average. X rights price times the period before rights issue. So times the period before rights issue. You give us there. Then you take ordinary shares after rights issue times period after rights issue. So you add the two, and that is your one-offs. That is your one-offs. So that is how you'll be calculating one-offs when there is rights issue. Usually I'll set it in a card. I still want us to be on the basic first. So illustration will be November 2019, question 5. Can we do this in the next class? 16 minutes. Do it in the next class. Then, so I want us first of all to do basic, is when we'll transit to dilution. Yes. So that is it. Purity says we are tired. So thank you. I want to remain with day class. I want us to discuss something in regards to tomorrow's class. Something came up during the session. I think it is interfering with my tomorrow, Wednesday, and Thursday. So we have to check how to cover those classes. So online, if you are not in day, you can just log out. We agree. Up to around 4. 46. What's missing is another issue. Something just came up. It's affecting tomorrow. For Thursday, we can do a makeup on Monday. You also theory and others. And I go to what I've been told there is a recording. So I'm just in trouble. So now, kuna mtu wa so I'm ending this because the class is being recorded. Then Ali Rose and Jennifer, you can log back using the same link. Let me end this because we are recording.